Hello and welcome to Moneycontrol. I'm Kaizad Adajania. As most of us know, equity and debt markets have been going through some really turbulent times. Whether you talk about economic slowdown, or whether you look at mid and small cap funds, or whether you look at the NBFC crisis that have impacted the debt funds, both the asset classes, equity as well as debt, has been going through some turbulent times. So, financial planners and advisors often tell us that one of the best ways to navigate these kind of turbulent times is through asset allocation. And I have just the person over here in our newsroom today, Amol Joshi, who is a financial planner, who's going to tell us what asset allocation is and how you can use it to your advantage. Hi Amol, welcome to the show.
Pleasure to be here, Kaizad. Thanks for having me.
So Amol, tell us what exactly is asset allocation? We know financial planners, advisors tell us regularly that you have to do asset allocation. It's a very cliched term. Right. So is it really such a cliche, or is there anything more? I mean, is there more to it than what it seems?
Right. The term asset allocation itself tells you that you have to allocate your investments across multiple assets. There is a simple reason why you should do that is all assets do not behave in similar manner. So you will not get steady returns across all the asset classes put together. The best example of that is last 6 or 7 years from 2012-13 all the way up to 2018-19, gold has probably remained flat. It has kind of given 0 to flat sort of a returns.
In the past 1 year, gold is gone
But
up.
past 1 year, it has done phenomenally well. Yeah. The thing is, if you are a gold investor only, then you would not be seeing any returns in 6, 7, 8 years. You would get frustrated, move out, and then it gives 30-40% returns in 1 year. For this not to happen to your portfolio, and for your portfolio not to be as volatile as this example what we have discussed just here, the simple solution for you is to allocate your funds, be it via lump sum or via SIPs, into multiple assets.
So you're saying that you have to have your allocation in all the asset classes, or at least as many asset classes as you have, like equity, debt, gold.
That is correct. Because equity, debt, gold, these are probably the most common asset classes, especially in the financial products or financial markets. There are other asset classes like private equity, or even real estate via real estate funds or REITs. But for the purpose of this discussion, we can simply say that debt, equity, gold probably are the most common.
For most of the investors.
For most of the investors, these are the 3 asset classes where your funds.
But the main concern that senior citizens tell us when they write into us, or even young millennials when they write into us and tell us that, for example, a senior citizen would say that, I'm 60, 70, I don't need equity in my life, I just need consistent returns, fixed income returns. Right. Millennials, on the other hand, say that, I'm a young person, I can take all the risks that I can, so let's invest everything in equities, and why should I invest in debt?
These two are perfect examples, Kaizad. Even I have experience which is similar to this. But the simple reason why we should have multiple asset classes, even a retired investor, if you are retiring at 55, 60, as per longevity, you have around 20 years of investments ahead of you. So when you say, I need only fixed income returns, there is a simple strategy called as bucketing. You can probably put 60, 70 or 80% of your assets into fixed income, where you will get comfortable regular income from those assets, consistent income from those assets, and remaining 20-30% can go to equity, which will help you beat inflation by a wide margin, and to some extent it will keep your portfolio in comfortable situation simply because you have around 10-20 years to go, and that's a reasonably long period. The second example, millennial who says that I'm 22, 25, I can take all the risk, I do not have any dependents, and why can't I go into 100% equity? The argument is okay on the face of it, but when the equity market goes down, you want to take more exposure to equity, right? The simple thing is when the prices go down, you want more of that stuff so that your upside is much higher when the markets recover. But when market goes down, if your 100% funds are in equity, you simply have no funds to enter at a lower level.
And your entire portfolio gets...
And your entire portfolio also gets impacted. So even somebody who is as young as early 20s, somebody with all the risk appetite that one can have, you still can have, let's say 80-20%, 80% into equity, 20% into debt. That 20% debt will help you take exposure when chips are really down in equity markets.
So that's all very good to at the start of the investment, like you define how much you want to invest in equity, how much you want to put in gold, how much you want to put in fixed income.
Right.
But on a consistent basis, what do you suggest? How should people rebalance their portfolios? I mean, markets will go up and down every day. Correct. So do you have to rebalance every day or once in a month, once in a quarter? Is there any systematic way of doing it?
Very good question. I would break down the answer into two parts. In previous question, we took two extreme cases. First, senior citizen 80 debt, 20 equity, and the second example 80 equity, 20 debt. In real life scenario, you will not necessarily have only one goal. So you can have multiple goals, some goal which is 2 to 3 years away, probably all of it will be in debt. Okay. So let's take for an example that your weighted average allocation comes to 60-40. Okay. That's the first part. Second part, what you said, do I have to rebalance daily? Actually, your goals, we are talking about several years. Even the nearest goal would be couple of years away. Right. The longest goal, let's say, is 20 years away, something like retirement, something to do with child's education corpus is 10-15 years away. So you can, it is not necessary for you to do rebalancing every day. In fact, I strongly advise against it. Okay. The best way to do is once in a year, when probably it's a bonus time for you, probably it's an increment time for you, when you want to increase or decrease your investments. That phase, you should sit with your financial advisor, look at the portfolio progress, and if the asset allocation needs to be fixed, that is the right time to fix it. Once in a year, unless there is some extraordinary event, once in a year is a very good frequency for rebalancing of the asset allocation.
So rebalancing as in, when the equity would have gone up in your allocation, right, irrespective of whatever where the markets are, sure, you need to like bring down your equity to the desired level and bring up the fixed income.
Again, we'll run with the same example, 60-40. Suppose market gives extraordinarily handsome returns in 1 year. So your equity component balloons up. So instead of 60%, that component now constitutes 70% of your asset allocation. So you'll simply have to exit 10% excess part of equity and reinvest into, invest into debt, so that your equity allocation remains 60-40.
Amol, many people wonder in these times, they've been looking at a lot of negative returns on their SIPs and their account statements. And 1 year, 2 year, 3 year SIP returns. What do you advise them? Should they stop their SIP? Should they pause their SIPs temporarily? Or should they continue their SIPs?
Right. So second part first, should you pause or stop your SIPs? We all by now know that SIP, one of the biggest advantage of SIP is getting averaging across the market cycles. Okay. If you have a 10,000 rupee SIP, if the fund NAV is 10 rupees, you are getting 1,000 units at that. Yeah. If the market has fallen, let's say by 10 or 20%, your NAV will be 9 or 8. For same 10,000 rupees SIP, instead of 1,000 units, today you are getting 1,111 or even 1,250 units if the NAV is 8. Okay. You are buying for the same amount of SIP, you are buying 10 to 20 or 25% higher number of units. If you do not stay invested or rather continue to invest at this phase, the entire advantage of SIP, you are not really taking that advantage. So unless, and I will always use this term, unless there is an extraordinary event of change in income pattern, or if you have taken some new responsibility of, let's say, home loan EMI, unless these things are not there, you are best advised to stay the course. And the first part, markets are volatile, 1 year, 2 year returns are flat or sometimes negative. I'm sure when you have started investing, if you are a DIY investor yourself or if you take help of your advisor, you definitely know that equity is a long-term asset class. Okay. So nobody invests or nobody should invest equity for a 1 year, 1.5 year sort of a time frame.
People do invest, but nobody should.
People do invest, but nobody should, because that is precisely that if you do that, that will give rise to this question that my returns are negative in 1.5 years, what should I do? If you have entered with a 5 year, 7 year, 10 year horizon, you have a lot of investment horizon ahead of you, left ahead of you, and that also is another important reason why you should stay the course.
So you're saying that stay the course, don't let markets bother you, as in don't let markets push you into taking a wrong decision of stopping or pausing your SIPs at these point in times, and you can still continue your SIPs stay on course to your goal?
Stay on course to your goal. You have started by investments for a 5-year, 10-year goal. If you are just 2 years down the way, no need to stop, because you are yet to cover 40%, 60% of your journey. And when the market will make recovery, all the units that you have purchased at lower cost over last several months, those returns will kick in when the market recovers.
What about SIPs in debt funds? Do you ever suggest your clients to start an SIP, let's say for an emergency corpus in a debt fund?
Right, absolutely. So, we have started this entire discussion with asset allocation. So, asset allocation does not necessarily mean that you will do asset allocation in a lump sum investments only. You can do asset allocation in your debt portfolio also. And some of the examples that you have given, the example that you given, SIP for creation of emergency corpus. One of the best ways of doing that is via debt SIPs. Now people usually these days take once in a year, once in 2 years, a long vacation, a big vacation in terms of expenditure. Since that is pretty short term, for 1 year or 2 year, again I am not going to advise you equity. So debt SIP can also be used to create a vacation corpus for yourself.
And even in a liquid fund also you can still do an SIP, even in liquid fund?
Yes, if you have anything like 6 months sort of a investment horizon or below 1 year, liquid funds are as good as any other. If you have a 2-year sort of an SIP, then I would suggest ultra short term funds or even low duration funds.
Okay. Thank you very much for your insights.
Pleasure to be here. Thank you.
That's all from us, folks. For more news, views and updates, visit moneycontrol.com.